All right, and we're live. Welcome to the second session in our entrepreneur education series, How to Approach Valuations. We've got two great guests here today. We've got Jonathan Lipoth from Rhino Ventures, previously of Broad Street Bulls. He brings a wealth of experience in both the pre-seed and seed space, and now as a venture capitalist looking at more of the seed and Series A rounds. And then we have Hark from Framework VC, an organization with, I think, over $100 million under management, investing in Series A, B rounds. So we've got, and they also spend a lot of time looking and analyzing deals from across North America and kind of the attributes that make for kind of a winning company, a winning startup company from different sectors. And so I'm really excited to dig into this conversation today. But before we jump into it, I want to welcome one of our special guests here at the top of the hour, Chase Christensen, one of our BFF sponsors from RBCx. Chase, how's it going this morning?
Doing fantastic. How about yourself, Zach?
I'm doing really well. So listen, I invited Chase on today because it's really important that all the entrepreneurs know that we've got some great sponsors around the table that can offer a lot of value-added services beyond raising capital. So a big focus to Startup TNT, helping entrepreneurs raise capital, introducing new investors in the ecosystem. But we like to work with partners that can bring all kinds of value add to the group. And RBCx is sort of a new division within the bank, RBC, and they're basically focused on entrepreneurs. So Chase, tell us what kind of magic happens when you add X to the end of RBC.
Absolutely. No, I love that. And I mean, similar to exactly what you just said, I mean, our focus is really around expanding beyond just that capital. I mean, it takes a hell of a lot more than capital to grow a business. And that's where the X component of RBCx is really focused around. So most recently, we brought on board our RBC Ventures team, which is about 400 individuals and stories within RBC that we're looking to be able to leverage those individuals to be able to support companies beyond saying, hey, here's a bank account, here's a credit card, here's a line of credit, whatever it may be, leveraging their experience and their backgrounds to help clients and companies scale faster and larger than before.
Yeah, and Chase, you just had a recent announcement. Do you want to tell us a little bit about that recent announcement?
Yeah, so that announcement about 2 weeks ago was with RBC Ventures joining the RBCx family. And so now it's all one team. We're integrating the teams, and really the intention there is, so RBC Ventures, for anybody who's not aware, is an internal group within the bank, about 400 individuals that have had experience building companies, scaling companies. So these have been companies either built internally within RBCx or acquired externally and grown within the bank and having those entrepreneurs on the team. And so with that integration about 2 weeks ago, we'll be able to leverage those individuals to support clients and to support companies and say, hey, we've got some top tier designers, programmers, HR individuals, commercialization experts, all within the bank that will be able to leverage and kind of help lend their expertise for those companies to help them grow. So kind of similar to, as you'll see, Framework and Rhino will help support their entrepreneurs. We're doing that from the bank side as well.
Yeah, and Chase, I think a lot of entrepreneurs that participate in our happy hour and our summits are pretty early in their journey. So a lot of them are only recently incorporated, looking at raising their first round of capital, maybe at the early stages of revenue. But some of them are more along the lines of like a late stage seed round. But Chase, what kind of thoughts do you have for entrepreneurs that are kind of at this early stage thinking about, bringing on debt, or what kind of services RBC might offer them, as they're thinking about their journey as a bank, offering debt options to entrepreneurs?
Yeah, absolutely. And I mean, hey, so from the debt side of it, debt is certainly a valuable tool, non-dilutive, can help augment some dilutive capital as well, and help just provide additional fuel to the fire to fuel growth. From the debt side, I mean, we always want to be very transparent. The debt isn't always the right tool for the problem at hand. I know that there is another great partner on the call here that is also a good provider of early stage debt solutions. Throw a little bit of shout out to Tara Benson with BDC there. But really early on, a big aspect of what we try to do, knowing that when the time is right for dilutive capital, what we want to try to do is provide some of that value beyond just that capital. If we can make introductions, if we can help leverage our network of 500, say, bankers and individuals within our RBCx family to make introductions to help extend your network across the country, knowing that the prairies are a small but important part of the country, growing in importance thanks to some great individuals on the call here, but we want to help that we can tell those stories across Canada and make connections outside of our ecosystems here.
Yeah. Well, Chase, I know that a few companies that come through the summit have been working with RBC and RBCx. And so I just want to encourage everyone on the call. Chase is a great guy. He's based here in Edmonton, but he has colleagues in basically all the cities across the prairies. So if you'd like to connect with Chase and learn a little bit more about RBCx, Chase, what's the best way for people to reach you?
Absolutely. Easiest way is to reach out to me on LinkedIn. Going to be the only Chase Christensen or the only Chase that comes up with RBCx. So pretty easy there, pretty unique within the platform. And so feel free to reach out. I can connect you across with any of the teams, ask any questions or answer any questions you may have on that. Okay, listen, thanks so much, Chase. I think we'll leave it there for now. Have a great rest of the day, and thanks for joining us here at the session. You too. And BDC is joining us next week, actually. Thanks for giving them a shout out. Okay. All right, let's get to the heart of the matter today, which is talking how to approach valuation. So we got two great guests, Hark and Jonathan. Let's just start with a quick introduction to both Hark and Jonathan and their firms. So Jonathan, why don't we start with you? Just quick, tell us a little bit about your background around participation in venture investing, John.
Sure. Yeah. So as Zach mentioned before, I was previously at Broad Street Bulls based in Regina. So I've got the prairie roots with TNT, and that's how I got to know the group here. But at the beginning of the year, I moved over to Rhino Ventures, and so I've been with the team since February. And Rhino has been around since 2015. It's the premise of Rhino was to be the funder that the founders of Rhino wish they had back when they were investing, or back when they were founders of the company themselves. And so the way that we do that is we're a very high conviction, high concentration investor in that seed stage that Zach mentioned. And we're sector agnostic, mostly focused in Canada, but also pretty flexible in terms of what deals we'll look at. So would love to chat with people more about Rhino after too, if they're curious.
Yeah. Can you tell us just a little bit more high level, like what is the Rhino thesis? What types of deals do you guys do, Jonathan?
Like I mentioned, I mean, pretty flexible when it comes to what deals we'll take a look at, but really down the fairway would be Canadian tech. And we have a couple verticals that we do focus on that we've had some experience in. That'd be fintech and entrepreneur enablement. And then so anything within those two categories, we have a little bit of extra expertise in. I'd also just tag on, I guess, ed tech as another one. And then the down the fairway check size would be about 3 to 5 million Canadian, but we can flex up or down.
Okay, awesome. And all right, let's chat with Hark then. So Hark, Framework VC. Hark, let's just start a little bit with your background. Tell us a little about your background and how you got into the venture capital world.
For sure. So first off, Zach, thank you so much for having me here. Looking forward to discussing valuations with everyone. Just in terms of how I got into VC, it really started with an interest in fintech and with the startups. I actually interned with a fintech startup in Singapore during my second year at university, and that interest in the startup world and also investing really continued forth throughout my internships in finance and then in my full-time career in strategy consulting. I actually joined Framework earlier this year, similar to Jonathan on the investment team. I guess I can give a quick overview about a Framework as well.
Yeah,
perfect. So I'm just gonna share my my screen if you don't mind. I just put together a couple slides just to help visualize, as to who we are here at Framework, and let me know if you guys can see it.
Yep, we can see your slides.
Awesome. Very So we
at Framework presentation mode though.
Oh, so let me just can you guys see that?
Yeah, that's perfect. Yeah.
Excellent. Yeah. So we have $290 million in AUM investing across 3 funds, and we invest into Series A, and B companies. We have four partners, 2 venture partners, and a team of 5 investment and operational professionals, and also 5 people on the data team. We're a very data driven fund, and we actually track about 30,000 startups in our own proprietary database, and out of our 19 investments, we have 3 unicorns and 4 successful exits. Then in terms
no biggie, just 3 unicorns, no biggie. Yeah, just throwing that out.
It's
common for all of us as investors. We got 3 unicorns in the portfolio. Sure.
Our goal as a fund is to build and to support 100 companies who are going to change the world. But it's quite exciting. And then in terms of our investment thesis, we invest in SaaS companies at this, and also marketplaces at the Series A/B range, and who display top tier unit economics, particularly a 3x LTV to CAC, and also 250% year on year growth. However, I believe that I will dive into some of those metrics later. And we invest in companies like with an ARR of typically $2 to $8 million across North America, Europe, and also South America, in the themes of fintech and AI. And we're a very hands-on fund. We have a full-time CTO, and also operational and talent expertise in-house, as well as a FP&A, and we use external consultants for go-to-market and executive coaching to support our startups.
Okay,
yeah,
awesome. Listen, and great comment here. I think Jesse mentioned that one of your colleagues is actually going to be joining us in Saskatoon for the Happy Hour next week.
Yeah. Okay. Barbara. So that's very on.
Well, okay. Listen, let's dig into the meat of it now. Hark, thanks for sharing. You shared a couple of stats about kind of like attributes of companies you're looking for. So maybe let me just start with a somewhat open-ended question. How do you guys approach, as venture capitalists, looking at Series A, B rounds, which, again, maybe for everybody in the audience, I think that the approach might be slightly different than when you're a pre-seed round, and we'll talk a little bit about the differences there. But let's start with you guys, Hark, at Framework. How do you approach this question of valuation?
For sure. So for sure. So in terms of valuations, there are a couple ways to approach them. First off, and that's like probably the most common is to use precedent transactions, and also comparable company multiples. So what that means is in terms of it's just understanding what are the similar startups in the ecosystem currently valued at based on their previous round. So if you have a company, and obviously no 2 companies are the same. However, if they are showcasing some similar metrics and similar problem in a similar industry, just to understand a ballpark as to where, as to what they were valued at in their next round. So that's in terms of precedence. And in terms of a comparable company analysis, trying to understand from a multiple standpoints, basically as a multiple of your revenue, where are the large public companies in the industry are trading at, and then assigning premiums and discounts, but based on the private company discounts, maybe take a 30% discount on that. So those are the 2 most common techniques.
Okay, yeah, that's interesting. I've had other guests sort of mention something similar. I thought there was an interesting insight one of them shared once. I think it was actually Pat Lohr from Panache, and I'll try and credit him here, which was entrepreneurs often think that they set the valuation, but the fact of the matter is the market sets the valuation. And that's kind of what you were hinting at there, Hark, by looking at comparables. And so you talked about looking at publicly traded comparables, which might be more relevant for those like Series A, B rounds. But what about what about these entrepreneurs that are still relatively early in the journey? Like, is the comparables analysis still relevant for them?
For sure. So I'd say that comparables help you understand, like in terms of the overall sector, because at the end of the day, whether you are a startup like in the seed round, if you're in the AB, or if you are later stage, you're operating in an industry and are typically competing for some similar customers. So comparables helps you understand, just to get a broad starting standpoint as to what could your valuation potentially look like, granted, if you were a much larger public company. And there are a lot of caveats to that. So comparables can act as a starting point, which can guide the initial valuation standpoint, and then from there, you can then look at the different options.
Yeah, I think that's really insightful, Hark. Like if you're trying to look at your own company 5 years from now, and you're like, well, if I can hit these kind of metrics according to my 5-year plan, what does a company hitting those metrics? What does that garner as a valuation in 5 years? And then you can work backwards to be like, okay, what's an appropriate valuation today to hit that? That would be a good return for me and my investors. That's like, I don't know, I'm just thinking about like how entrepreneurs might try and translate this right now. Okay,
for sure.
I want to ask one more follow-up for you, Hark, and then I want to get Jon's opinion on some of these same topics. So, Hark, what are the types? You mentioned a couple of things that you consider, like LTV to CAC ratio. Let's just define that for everybody. So that's lifetime value to customer acquisition cost, like comparing how much money you're making per customer to how much you have to spend to get that customer. Overall growth rate, and then the annual revenue today. When you're doing comparables analysis, are there any other metrics you're looking at when you're trying to do a comparable between two companies? It's not always a straight apples to apples comparison.
For sure, yeah. So I guess I'll talk about some of those metrics first, and then relate to overall comps. So the reason why we look at some of those metrics, including the year-on-year growth rates, what the customer logo retention is, as well as the MRR expansion, margins, etc., is to understand how well is the company performing on a metric standpoint compared to the other companies in the industry. And like if it is performing better than the other system companies, perhaps it should be assigned a premium in terms of the valuation. And so understanding the metrics and the growth, for example, if you are growing at 200% year on year, but the majority of your competitors only at 50% or at 100%, there is a case to be made for your company to be traded at a higher valuation.
Okay, thanks, Mark. All right, let's get Jonathan's input on this sort of open-ended question, Jonathan. I like to leave it open-ended to start. When we're talking about Rhino, how do you guys approach this question, valuation? I do think it's probably the trickiest question for new entrepreneurs to ask themselves. How do I set my valuation? What are your thoughts on it, John?
Yeah. So I think I'm going to run with one of the last points you kind of made there, Zach, that this, I love hearing from people like Hark at Framework, where this is like a stage later than us, so that to work backwards from knowing what they look at, what public markets beyond them, I guess, if you continue to project what they're all looking at, and if you work backwards, the way that we would kind of think about it is what you would call venture math. And so at the seed or the really early stages, when even if you're pre-revenue company, I mean, so even at Rhino, we have invested in pre-revenue companies, although not not always down the fairway, but it's something we do take a look at. We consider we kind of consider the realm of potential buyers or how the public markets might view this company, and that kind of informs us for what this company might be worth upon exit, or many years down the road for us. And then we have to work backwards using venture math to say, okay, what can this company potentially return for us? And then that kind of helps us solve for what the valuation should be. So every company is different because every market's different, and the way that you value each company in each market is going to change. So we have to look at that for each individual company. How do guys like Hark look at this company, and then how do the investors beyond Framework, and then the public markets, how might they view this company in 6-7 years from now? And then when we work backwards, then we can go, oh, this is the type of valuation, the ballpark that we need to see returns in our fund. And that strategy too will change with each type of fund, whether you're going for 10 companies, 12 companies like Rhino is, or you're going for many more.
Yeah, so there's a couple of components in there. Maybe we can analyze them a little further, Jonathan, which is, so you're looking at how well are we predicting the growth of the company, which is always a challenge. And then what type of valuation increase or valuation lift is an investor expecting? So do you want to maybe just like touch on those 2 points, Jonathan, if you're investing at these early stages on trying to like make a conservative estimate of where this company could go and what type of increase in valuation you want as you're thinking about the different rounds?
Yeah, it's a good question. So I think I'll answer kind of the second part there first.
Sure.
In terms of what we look for in a lift in valuation, this also ties back to I think what you were saying, and then again credit to Patrick Lohr on this is where the market sets valuations, and we like to think that there's kind of a formula of like, oh, if you raise your seed at a 5 million, Series A at a 15 or 20. Then your Series B should be this size, and it should go up in a step function, and it kind of looks like this line. And it's not really
so
the
it's
case.
going up. So it's
Yeah,
going
it's not.
up.
That happens to be the case when multiples go up, and when you have increasing traction or increasing revenue or whatever the key metric is for the businesses. But that's the market has to set that, and the market will set it based on where you're at when you go to raise. So there's not necessarily, I think, like a formula to say, it's going to increase by a certain amount at each step function. And the fundamentals of what the market looks for change. And I think what's also super interesting is we've seen, especially in public markets, a shift from valuing growth to valuing more margin, EBITDA margin, and profitability. There's some interesting data you can, if anyone follows Thomas Tagoons, he released some really interesting data from Redpoint a few months ago on this, and just generally in the markets, it seems to be what's valued higher, and especially in software. So anyways, those are all things that we look for when we're trying to project ahead what a company could be valued at. We have to be realistic about what the exit range is. So I did that kind of answer the questions there?
Yeah, no, I think that's a good input. I don't know. I think that one of my questions is kind of unfair because it's like how can you predict accurately where the company's going to go in 5 years? And the answer is you can't.
Well,
so
the question there is how good are we at our jobs, I think. Yeah.
But listen, there's a great question from HC that I think goes right to where I want to go next in the conversation anyways, HC. So, for public markets, what time period do you advise entrepreneurs look at given the all-time highs of 2020, 2021 and some subsequent downward adjustments? So maybe Hark, do you want to take this one first? Should we be looking at like what the comparables are right now today, or should we be looking at the comparables over the last like 3 years? Because the markets sometimes are fluctuating. The markets might be going crazy, and the comparables might be a bit of an outlier at any one given point in time. So, Hark, what do you think of that?
For sure, yes. I guess like two things that I'll talk about columns and also in terms of transactions as a guideline. If we're looking at similar transactions that have occurred in the market, we will put a lot of focus on transactions that have occurred in the last 6 to 12 months, as that's a reasonable time frame that gives enough time for enough transactions to be in scope, but also captures enough recency in terms of what is happening in the market. In terms of actual comparable company analysis in terms of metrics, so that basically changes like every day in terms of the public comp stock price, right? So if you go onto Yahoo Finance, and this is all public information, you can look at a company's enterprise value, and they will have revenue metrics, and if you divide the EV by the rev, then you can get a multiple, and that kind of change. That's a snapshot as of today. However, you can also do that kind of analysis in the last 2 months, 6 months, 12, et cetera, just to understand where the market has trended. And also even beyond that, you can even Google it and be like, in this industry, like what are multiples typically? Because granted, we are in a business cycle, valuations go up, they also go down. Like what is a normalized metric? Like then typically that could be for SaaS in certain industries, I call it maybe 7 to 10x. Granted, depends on multiple variables. SaaS, which is hardware versus industry, let's say 7 to a 10x is a starting point, and nowadays let's say it's around 7, if not slightly lower even.
Yeah, well, maybe Hark and Jonathan, maybe we'll ask Jonathan go next, but I'd like both your opinions on this. So if we look at specifically 2020, 2021 being kind of record-breaking years for the stock market, for VC investment, I think it was also record-breaking years just in terms of the valuation lift people were seeing between rounds. And we at TNT sometimes we've done a little bit of we follow the pitch book data that shows that increase in valuation is actually going down right now. So people aren't seeing as big of a lift between a Series A and a Series B round and beyond. IPOs have dropped off significantly. How's that translating right now for the deals that you guys are seeing? Is it maybe the one other factor I'll throw in here is I also know that there's a lot of dry powder out there. There's a lot of VC funds flush with cash, but valuation is still trending downwards. Any kind of thoughts on that current situation right now?
Sure. John, do you want to take that, or who do you want?
Who wants to go first?
I can jump in. I think just to introduce kind of the way that we would think about the timing piece, and then I'll get into specifically 2020, 2021. We have to look at kind of this delayed effect of the market, because so to Hark's point, when you're looking at in the rearview window for 6 to 12 months in terms of the data for multiples, you're also kind of looking ahead 6 to 12 months at what you think the next round is going to buy into, because the next round is the buyer of your portfolio and you're incentivized to mark that up, of course. So if you kind of trickle that down across all of the different rounds, if you're going from public to growth stage B, A, seed, that's a 6 to 12 month delay before you really feel that impact on the stages of the of your fund. And so it's a bit delayed going from stage to stage, and everyone kind of reacts at different times. So but you do still have to keep in mind as an investor, again, projecting ahead, again, with your question of how good of a job can we do projecting what this company is worth, you have to think about what the valuation, or especially the multiple, to Hark's point, is going to be at that time. So that delayed effect really does kind of play in the market. And this goes back to, again, why investors typically are the ones who end up setting that. Hark, I know you mentioned, before I get into 2020, 2021, you came up and if you have anything to add.
Yeah, Hark, go ahead.
Yeah, no, I fully agree with what you said, Jonathan. It's really important to look at the future, because historicals are past, right? There's nothing that's it's you have to look at the future. What do we think is actually going to happen? And to answer a bit more of your question, Zach, as to what multiples have done. So granted, valuations are lower these days. While there is a lot of dry powder, there are a decent amount of investors, who are being a lot more conservative, call it, in the investments that they make, and they are being a bit tighter with the money that they invest. We as a company have a framework. We are using the same strategy that we have been using over the last few years. We're typically in the market, while there is a lot of dry powder, VC dollars it is hard to come by, and as a result, companies who perhaps may have been able to raise easily 1 or 2 years ago are now having a difficulty raising.
Yeah.
Guys, John, go ahead. Yeah.
Oh yeah, if I was just going to briefly touch on and answer that question, I guess, directly of 2020, 2021 as well.
Yeah, go ahead. Yeah.
If you look at so directly, not necessarily at valuations, but at multiples, there's a really good chart online by Altimeter, who plays in both public and private. So they have, I think, a pretty good line of sight into what this market looks like. They released some data. This was in May, I think, so it might be a little bit updated, but looking at how the multiples in software, specifically in public markets, have fared. And they corrected by about May, they had corrected back to the historical average of 2015 to 2018. So the long-term average is kind of what is being corrected to, and it was not followed whatsoever kind of late 2019 to mid to late 2021. So those I would say that this around that at historical average is probably what you can expect for later stage. And also, again, to what I was saying earlier, how the earlier stages are going to react to what they're forecasting for their exits.
John, are you able to share the website in the chat here?
I think it was actually put on Twitter. They don't really release a lot of data, but I can find it and I'll try to post it in the chat.
We need to find this tweet.
Yeah, I'll find it.
But I think this, I've seen other sources sharing similar insight, John, where it looks like, 2020, 2021 being a bit of an outlier year for a few reasons. And now we're kind of returning to the mean. So maybe that's something, I think it's probably beneficial for all of us in this space, entrepreneurs and investors, not getting too excited or too conservative. Ideally, we're returning to the mean. So kind of short answer to the question. So given that consideration, why don't we answer a few questions that we can maybe use a bit of a case study. Why don't we use like a hypothetical company? Hark, why don't we start with yours? If you're looking at a Series A round, you kind of mentioned this at the beginning, but let's repeat it and maybe just dig into it for a second. Like, what are the typical attributes you're seeing of companies that are raising money at a Series A stage? Like, what are the kind of the key metrics that they have, and how much money are they raising? And then why don't we kind of work backwards together to think about what that might impact what a pre-seed or seed company might be doing right now. So let's start with, what does a Series A company look like, Hark?
Sure. So I can talk about some of the key metrics and what we look for in Series A rounds and what many other Series A VCs do. So year on year growth, we want to see lots of growth, obviously. I'd say to raise a venture round in this market, you probably need at the A level over 100% year on year growth. We typically companies who have 200, if not 200, and a 50% plus year on year growth. Margins, again, it really depends on the business. If you're talking generalized simple SaaS, it's 90 to 95%. But that's really generalizing things. We look closely at the customer retention and the MRR retention. So in terms of customer retention, we want to see a 12-year customer retention to over, call it 90 to 95% on an annual basis. So call it no more than 10% churn per year. And that depends, right? If you're targeting enterprise customers, we would like to see less churn. Naturally, if you're targeting consumers and it's more of a B2C, naturally there is going to be more churn, maybe around 20% churn. In terms of MRR retention, so in terms of how much is each customer actually putting in, we want to see that trend moving up. So if a customer today is paying $100 a month, or a customer, let's say 2 years ago, is paying $100 a month, we want to see them 1 year later now paying 120, 130, and then 2 years later paying 150, 170 plus. So and that proves the customer really likes a product and is willing to actually spend more and to actually.
What's the metric you use for that? That's like average monthly revenue per customer or something?
Yeah.
Trending going.
Yeah. So. Yeah, that's exactly. Yeah, so into the average revenue per customer, and we also basically so what we do on a per customer basis is to look at each customer or on each monthly cohort, what was the first month of revenue, and then make that equal to 100%. Then every subsequent month after that, what is the percentage? Is it 90%? So the next month did the revenue go down by 10%, or is it 110%? So you basically equate it to the first month of the revenue and then chart it out and see how that trends. And then typically at the A level, I'd say companies are not going to be generating positive EBITDA or net income. However, we do invest in companies that have positive gross margins. So we look at the revenue minus the COGS. We need to see positive gross margins, because essentially what that means is, can you offer this product profitably? In terms of the business overall, can you run a business profitably? That's what the EBITDA and the income, but the product itself is the gross margin, and we'd like to see that. In terms of the round sizes, I guess thinking revenue, so typically targeting customers with an ARR, an annual recurring revenue, call it 1 to 2 million plus, call it a 2 to 5 million, maybe 2 to 10ish million. And then round sizes can range anywhere from high single digit, I think, in the A, so we'll call 7, 8 to about 10 to about $15 million in terms of a round size. That's an average as to what I've been seeing in the last few months in the market.
You know what, Hark? I really appreciate that. I hope everyone on the entrepreneur, like this was recorded, guys. So you can go back and listen to Hark's and rules there. But like that was like some of the most detailed insights I've heard about like what are the features of a Series A company that you're seeing. So I really appreciate sharing that, Hark. Might hand it over to Jonathan. Jonathan, that was like a really good detailed list. How does that compare to what you guys are thinking at Rhino VC, or do you guys look at things a little bit differently?
So I think Hark's perspective on Series A is going to be a lot more, I guess, a lot stronger than mine. So we are a lot more focused kind of on the earlier stage, and we aren't as focused, I think, on like what the Series A kind of metrics necessarily look like. But all of the things that Hark kind of points to, if we're looking at especially like a SaaS company, looking at the not just the growth of the revenue itself, but also net dollar retention, churn. And then on the other side, the other thing that we're really keen on is how capital efficient has this business been, and how capital efficient can it be in the future. Because one thing that we're also keenly aware of at the seed stage is every round after us dilutes us. So we also understand that this business, while there's incredible returns and upside on the other side, we also have to understand and also put a bit of a guess and a number behind how much is the capital will the company require to actually achieve that, because that does dilute returns. So anyways, I can't give nearly as good of the hard numbers as Hark did there, but that's generally what we're considering and the way that we think about what we're investing in.
Well, I actually really like that capital efficient comment at the end, especially for these companies that are too early in their lives, which a lot of the people on the call are. You're too early in your life to be able to hit these metrics that Hark just listed, because that's going to happen in a couple of years. So then this question that Jonathan brings up, which is like, how capital efficient are you? Like how much money, like just to define that for us all, is that how much money you're spending to achieve your goals? Like is it cost $1 million a year or $100,000 a year?
Yeah, so it comes down to not just burn, but also kind of where that's being allocated, or like we like to think about, it all kind of comes more or less down to that ROI piece of like, if you could achieve $2 million in revenue or $1 million in revenue, how much do you need to raise to actually get to that point? And then also kind of where you're coming back to like, if you figured out unit economics, also what Hark was saying earlier, then you can somewhat know what that is. But also at the early stages, you also often are too early for that even. So you're making an educated guess on what those economics look like, or some range of that, and how you could feasibly actually achieve that revenue, or way down the road EBITDA. So that's somewhat how we would think about that.
Well, Jonathan, let's continue on this topic here. So what is a typical timeline that you're looking at between that seed round and the Series A round? And like, what are you kind of recommending entrepreneurs?
It totally depends on every company. I mean, again, to mitigate dilutive effects, like the in-between answers, like as long as possible, or you want to be able to actually like prove out the company, prove out your metrics, and make it easy to kind of fit in what a Series A investor is looking for, so that you're checking all these boxes and hitting all these milestones. And so runway is super important for that, but again, kind of the efficiency piece is I'd say more important than just simply runway.
Mm-hmm.
Well, guys, there's a couple of questions coming in kind of about like thinking long-term, like how much money does this company need to get to exit? What is an exit strategy? And actually, one of the things that I've kind of like thinking about more recently as I evolve as an investor is actually thinking more in short term. Like, how do you get from here to the next round of funding to sort of continue on this track of success? I'll let you guys maybe comment yourselves on that kind of thought process.
Yeah, for sure. And so just like a quick thought in terms of efficiency, it's like looking at the LTV to CAC, because that's really efficiency on your growth and your sales marketing spend. So target that to be above 3. Okay, so the next point, right? So like, how do you get to the next stage in terms of exit or profitability? So when we invest in rounds, what we want to understand is the use of proceeds. So essentially, if you raise $10 million, or if you raise $2 million, or even $1 million, what are you going to use that money for? And so let's say that if you raise 10 million and you're going to use 3 million towards sales and marketing, you have to understand, like, with that 3 million, how much can the business grow? So how much do you need to invest in the business to reach certain targets? And so that's in terms of revenue, right? So what you can proxy that with is in terms of the cost of customer acquisition. If historically, let's say, it cost you $50 to get one customer, and you now have $1,000 to invest in the business, if you assume the same CAC, it now means that if you continue the sales and marketing the same ways you are, you will now get 20 customers, because it costs $50 to get one customer. So that's 1,000 divided by 50, and that's 20, and that can be scaled up. So if you consider your
Oh no, Hark, I think we just lost you. Hark, I think we're having a bad connection. It's okay, Hark, we're gonna get you back here. Jonathan, how's your connection?
I hope good. You can hear me?
I can hear you great. I can hear you great. Hark, I'm sorry. I think we lost your connection. So we're going to keep going here. Hark, hopefully we get you back in a second. But that's okay. Jonathan and I are going to keep talking about these topics. So Hark was talking about like kind of how to think about your capital spend. Why don't we talk a little bit about like the runway piece. Hold on, sorry. Let me check my notes here. I got structuring the round for success. Okay, let's talk about structuring the round for success. So we talked about runway. Jonathan, you're trying to tell people to extend as long as possible, but I know that the reality is it's probably only 18 to 24 months max. Any thoughts on deal structures? We're going to talk about this at detail next week, but Jonathan, as someone that's invested in both the pre-seed stage with Broad Street Bulls and now at Rhino Ventures, what are your thoughts on the deal structures that make sense for the entrepreneurs at these early stages?
Yeah, so I think generally I'm a fan of keeping things relatively simple. I think rounds that get too complex early can make it also complicated to bring on other investors later down the road. That's not necessarily mean that there's no room for complex rounds, or that completely, I guess, turns off other investors. But I'm just simply more a fan of keeping things simple. And sometimes the case, that's what we would generally prefer, especially kind of at our check size and at the stage that we're going in. It's most rounds that we see will end up being like a pref share, but that's again kind of not also what's typical at the pre-seed stage. You'll see a lot more notes and kind of other structures. So I think that's totally fine too, but again, just more a fan of simplicity than not.
Jonathan, are there any like features or sort of weird things that you've seen in a deal at an early stage that cause problems for you guys in the later stages, like things to like avoid almost in either like a crazy high valuation or even just in the general deal structure? Do you guys have any thoughts on that?
Yeah, good question. There's nothing that I could speak to like as an example or as an anecdote, but what I can say is like anytime where you're adding in warrants at the early stage, or even like liquidity prep, anything or liquidation prep, like anything like that, typically the next investor is going to look to get that or better. So anytime that you're taking that on in the deal, you're going to want to remember that for the later stages, because the next round of investors either going to want that deal or better.
Okay, Hark's back. Jonathan, all right, I think that's sound advice. So Jonathan just basically shared, whatever sweet deals you're giving to your investors today, your future investors will be like, well, I need that sweet deal too. And there's only so many sweet deals to go around. So keep that in mind as you're structuring these things. Okay, let's address the question that just came up from Two Mountains, because I think it's an important one. How much equity are investors looking for, or to flip that around, how much equity should the founders on the call be thinking about that they're going to have to give up every time they do a round? Obviously, investors want more, entrepreneurs want a little less. I love this expression from my friend Arden. We want to negotiate fair deals, not founder-friendly or investor-friendly deals. What's a fair deal? So I get both your opinions on this, but maybe Hark, you want to start it off for us.
Sure, yeah, before I judge like a fair deal, it's like one consideration is just to who your investor base is and also who is leading the round. So, for example, we only lead rounds, and we as Framework also take a board seat as that allows us to actually help the company, but. A board seat comes with a certain ownership percentage typically. All right. So that percentage depends on the jurisdiction, is typically 5%. Right. So for a lead investor to get a board seat at the A, I'd say is around 5% minimum. Where we're typically, I'd say, it depends on, again, the round and the size. Would say a general rule is going to be really wide range. I'd say it's around like 10 to 15%. It could be a bit less than that. Could be slightly more, but at the A, it's probably around like, yeah, 5 to 15, probably around 10 percentage. Like,
okay. Is that for
previously,
you guys, Hark? Just to clarify, is that for you guys or is that for the whole round that you're thinking?
I'd say like that's for the whole A. I would say, and like typically, like at the A, and like many years ago, investors were taking up to about 25%. However, that percentage has been coming down.
Yeah. Okay. Jonathan, what are you seeing in kind of the deals you guys do? What kind of range of equity stake is the round?
Pretty wide range. And I'll speak to, again, like past experience on pre-seed. I think it really depends on the type of investor that you're bringing on. To Hark's point, like, and we're similar in terms of we like to lead rounds and we typically like to take a board seat. So when you're dealing with an investor that can cut a bigger check and is kind of taking that board seat, you'll expect to give up a little bit more. So the cost of that is a little bit more equity at the early stage. But if you also think about, like, traditionally, every stage you give up 25%. Or 20 to 25% kind of historically, if we give like a kind of a ballpark, like even if those percentages are coming down, if you can do one round at 25 instead of having to do 2 at 20, then you're saving some dilution. So it still really depends on the investor and who you're bringing on. Because the other thing is, if you can get somebody that's a little bit more strategic, or is an investor that tends to double or triple down kind of later on, and you're not having to spend as much time in market, because that is a big distraction kind of down the road, then that is something that's valuable, and potentially might be worth giving up more equity at the early stages. But again, depends on every company, depends on every round, and kind of if you could get to you have to plan ahead for fully funding the company.
Yeah. All right. Well, you guys actually gave a pretty broad range. So I heard kind of numbers ranging from as low as 5, but I think, yeah, that sounds pretty low, Hark. So 5 to 25%, maybe the more realistic numbers are in that 10 to 20% range. Just for entrepreneurs to kind of think about, what does a typical round size look like relative to the valuation of the company? Jonathan, do you want to try to answer this question from HC? Do you see in the chat here? With respect to assessing runway and financial positioning pre-investment, what specific financial calculations do you look at?
Yeah, great question. Those are the main calculations. Actually, I can't drop some magic for other formula that we would look at. Really, capital efficiency, reducing dilution or mitigating dilution. And then also just having adequate runway for as long as you can, really, is kind of the main variables that we're playing with. But at the end of the day, like, it is going to come down to what do you actually need to get this company to hit the milestones for the next round, or to make it to whatever the goals are that you have. And I think the growth trajectory of every company is also going to look different. So I can't, to be honest, I can't give a great answer on that.
And also just add, I think a lot of the metrics Hark listed, some of them might not sound like financial metrics, like customer churn, but they all impact finances at the end of the day.
Totally.
So those kind of metrics are super critical. Yeah.
Actually, one thing I will add into that too is, for some companies, you also are dealing with a sort of typically not for like SaaS, but for other companies, you're also dealing with a cash conversion cycle, or you might be dealing with any sort of like working capital cycle. And there too, you're going to just simply need more capital to actually operate the business. And so you need to factor that in. And typically VCs don't like funding that kind of working capital gap. So you might be looking to get like a line of credit or other ways to financing the business that also impact your capital structure.
Okay, guys, we're getting close to the top of the hour here. So I just want to I got two more questions. Also, just maybe call to the audience, guys. Anything you guys want to talk in further? We got 6-7 minutes left here. Throw it in the chat. We can discuss it a little further. I got two more questions for everybody. First one is we talked a lot about the importance of looking at like kind of what the market looks like today and comparables. Where should we go to find that data as entrepreneurs? It's hard to find this data for these comparables for these early stage companies.
Yeah, for sure. It's like where you can go to get data, like on terms of comparables. Like I guess like talking about public comparables, like where things are trading. So honestly, like you can go to Yahoo Finance and you can pull the company's revenue, and they have calculations for the enterprise revenue. And for each company, like if you look at the 10 closest public comparables or 5, if you look at those two metrics, just go to each of the Yahoo Finance pages for those companies. You can pull that information. There are many other sites that also have a lot of that public information. If it's not too disclosed and it's a public company, you can look at their filings. If it's an American company, you can look at the EDGAR database, EDGAR, run.
Oh no, I think we might have lost Hark again. Hark! All right, EDGAR database though. Okay, you were getting at something I wanted to make sure we mentioned, which is if public companies are buying smaller companies and you're thinking about your own acquisition, you can sometimes find the details of those transactions in public filings from a public.
So just to maybe finish the sentence, I assume this is where he's going, was there's EDGAR and then there's CEDAR in Canada. So those are two you can look at.
EDGAR and CEDAR.
Yeah, and there's also way easier, their databases are also very difficult to navigate. So if you would rather find, there's other ways you can find their reports. There's an app called Quarter that I use. Yahoo Finance is good. Koifin's not too bad. So
yeah. And then there's two databases you have to pay for to get good data, which is Crunchbase and PitchBook. PitchBook is extremely expensive. I know a lot of VCs use it, but it has really, really high, high quality data, but it is quite expensive. So it's probably not worth it for most entrepreneurs because I think it's like $20,000 a year.
Yeah.
Crunchbase might be a better option for an entrepreneur. I think you can get pretty good data from that for more like a few $100s a year. Okay. Jonathan, anything to add in terms of like finding resources? And then we have a couple of questions.
Yeah. So I think to your point, it's very difficult to find like broad data. So even if you can't find like a bunch of companies that are within your comp set, what's I think really key is even just looking at a few comparables that are really strong comparables. And one of the biggest things that I look for when I'm looking for comparables is matching kind of revenue quality or margin profile. So if you're looking at a business that is, if you have a SaaS business that has very high margins, and almost no, almost zero marginal cost to distribute, you should be looking at a company that is similar, has a similar margin profile. Whereas if you're a company like an e-commerce company where you have lower lifetime value because maybe repeat purchases are lower, but still high ticket, and then also high customer acquisition cost and lower margin profile, then you have to look at companies that are within that same margin profile. So that is one of the key things that I would encourage people to look for when they're looking for the fewer high quality companies.
Okay. Thanks, Jonathan. Okay, we got Hark back. Listen, we've only got 3 minutes left, guys, and a couple of great questions just came in. So let's try and answer these relatively quickly if we can, because do you guys have to leave right at 11? What's our time?
I do, unfortunately.
Okay, John only has 3 minutes left. Okay, John, what's your opinion of safes? Should people use them? Should they stay away from them? Safe notes. What are your thoughts?
I don't have a strong opinion, I'll be honest. We used to do them when I was at Broad Street Bulls. I don't see them as much when you're kind of dealing with larger rounds. What I will say is, like, when you're dealing with a larger check size, it just simply might be more valuable, or you can spend the money to open up your books and do a share purchase agreement, but not always is that actually worth it when you're doing a smaller dollar figure because it is expensive.
Yeah, I think safes are there's a growing trend where safes are kind of a cheaper version of a convertible note and looking a lot more similar to convertible notes. And so I personally think that they're a great instrument. That's my opinion.
Yeah. So in terms of safes, like, look, there are some pros, right? Like they are that there is no interest. It's cheaper than a note, and like it's easier to, like, there are less items to negotiate on, right? You have how much money the investor puts in, the valuation cap. Like, one of the issues with the safes is that it pushes the valuation to the future rounds, and if the valuation cap is not as like, if it's off for founders can potentially see a lot more dilution than they expected to in the first place. So there has to be a lot of consideration surrounding valuation and the equity dilution.
Okay, thanks, Hark. Listen, one question for Jonathan before he leaves, and Hark, I want to answer it too, which is great, from Kayla. How do you have this conversation about valuation with your investors, Jonathan? What's your advice? Show them a spreadsheet, just have a casual conversation like this. How should they approach the subject?
Yeah, also really good question. So again, this goes back to, like, often the investors are going to be the ones who set it. Again, back to like the market discussion. So especially when you're getting a lead, when you're getting an investor coming in, you typically, the discussion will kind of start in that negotiation phase after you determine that this is an investor that you want to work with, and the investor wants to invest. And that kind of negotiation, I think you can both approach with like what that, both like what you, I think both need to provide the perspective on like what the outcome of the business looks like. In other words, what is that range of exits? And then together you can work back from there to determine what the exit or the entry valuation should be, because that is the biggest lever that the investor has. So it's not necessarily like you approach the investor all the time. It's I think quite a negotiation.
Yeah, I think often the investors approach you about it. And I'd also just kind of general recommendation, in the first meeting, you probably don't need to get into the details of your valuation. That's like a get to know you meeting. This is something that might come in your second or third meeting. And for some investors I know that are sophisticated, they'll actually just pitch you what the valuation should be. Some investors want to wait for the entrepreneur to pitch it though. Okay. Hark, you have any other thoughts? Jonathan, if you have to leave?
I do. I got to hop. Yeah.
Okay. Listen, let's give Jonathan a big thank you for coming. We can sit around for 1 or 2 more minutes. Hark, if you want to answer a couple more questions. Jonathan, thanks so much. Jonathan from Rhino VC, based in Vancouver. He's been a longtime friend of Startup TNT, one of our ambassadors, in fact, back in Saskatchewan in early days. So thanks for coming on today, Jonathan. And how can people reach out to you if they want to contact you?
Thanks so much, Zach. It's been super fun. They can find me on LinkedIn, Jonathan Lipoth. There's not a lot of people with my last name, so it should be relatively easy to find on LinkedIn. Just shoot me a message with the invite, just so I know that you watched this talk here, and we can go offline.
Yeah, kind of a reminder that people like Jonathan Hark probably get a lot of people reaching out to them. So make it personal, make it customized, make sure they know who you are. Yeah. Okay, thank you so much, Jonathan.
Yeah, thanks everyone.
All right.
Hey, John.
Yeah, see you, Hark.
Okay, Hark, you know what? We are kind of running out of time. So I actually kind of wanted to ask one final question as we're wrapping things up, which is, what kind of due diligence should the entrepreneurs be doing on the investors? How should they think about, like, is this an investor I want to work with? There's 2 people in this equation.
Definitely. Yeah, look, I think that's an extremely important question. So typically, what we do, well, I guess one, like, try to understand what kind of companies they have worked with in the past, and then what kind of startups has the VC invested in. To understand, would they have experience and actual knowledge in the space? They have only done typical fintech SaaS deals, and now all of a sudden they want to invest in healthcare or in med tech. There may be a bit of a disconnect. So understand that. 2, typically, so after we issue a term sheet, or I think even before in some cases, we also offer references to our startup CEOs, in which we happily invite the company to speak to our current portfolio CEOs and ask them questions about us, like, how do we operate? I guess like how involved are we in the board? What has been our value add, and to ask them candid questions.
Well, Hark, I'm glad you mentioned that last point, because I actually think that's the most important thing for the entrepreneurs to do when you're looking at investors that could be coming in, joining your cap table. It's a long-term commitment. You're going to be with these people for a very long time, 5 to 10 years. And it's kind of like a marriage. And so doing some homework on the investors is really important. And the best way, I think, is actually just to talk to entrepreneurs that have received their investment in the past. What's it like to work with them? So
definitely.
Listen, Hark, we're just over time. Why don't we end it here? Thank you so much, Hark, for joining us from Framework VC. Hark, how can people reach out to you if they want to get in touch with you?
For sure, yeah. So similar to John, please do add me on the LinkedIn. Send me a message. There are not too many Harks in the tech world in Canada. I've not met any others yet, but my full name's Harkirat Ahluwalias. If not, feel free to email me. It's just Hark, HARK, at framework.vc. So that's Hark at framework.vc. Please do reach out. I'm happy to chat or to help in any way.
Well, listen, Hark, thanks for calling. Thanks for joining the call, I should say. And just to recap for everyone, I thought there's some really good insights here today, looking forward at the comparables analysis of where your company is going to be, what it's going to be worth in 3 or 5 years from now, and then working backwards about how much money you need to reach those goals, and then thinking about your valuation from that vantage point. How much equity is typically given up? What is the market paying for companies today and companies that I'm trying to be in a few years? And just kind of really taking a systematic approach to this, so that when you talk to people like Hark, you are as informed as they are when you talk about valuation. So with that, let's end the call. Thanks so much, everybody. We'll be back next week. We'll be talking more specifically about how to structure the round, different deal terms that make sense with our friends from BDC and the 51. So with that, we'll end it here and enjoy the rest of your day, everybody. Join us at the happy hour tonight. Unfortunately, Hark, we don't have one in Toronto, but we do have one in Winnipeg, Saskatoon, Regina, Calgary, and Edmonton. Thanks, everybody.
Thanks so much, everyone. Take